is a part of Saxo's investing session, a series of webinars designed to help you get started and become better investors and traders. I'm joined by Peter Six, who is an investment coach based in the Netherlands in Amsterdam. Peter has been with Saxo since 2010. He has extensive experience in financial markets, having worked as a floor trader, as a manager, and even wrote 2 books that were relatively successful in the Netherlands. Today, we're not going to give you any advice or recommendations, but Peter will provide strong guidance and will give you some tools. So by the end of the hour, you would not be asking us or anybody else what to do. I believe you would be able to do it, basically start building a portfolio if that is what you want to do. Now, some important information about the webinar. It is for educational and informational purposes only. We're not providing any recommendation or advice. Investing involves risk, including the risk of loss. And before making any investment decisions, you should consider your own situation, your investment objectives, time horizon, and risk appetite. Here is the agenda. Peter has about 40 minutes of spiel. We have 20 minutes at the end. No, sorry, not 20, 15 minutes at the end for Q&A. Please feel free to type in your questions in the chat at any time. If it's relevant during Peter's speech, I will interrupt and ask your question. Otherwise, we'll do it all at the end. And we'll also have a short survey, just 5 or 6 questions for you to answer to help us serve you better and provide you with better webinars. So now I'm done. I'll give the floor to Peter.
Yeah, I will share my screen. And then share, I go. And I hope you can see it. Thanks
Yes,
for the.
we can see it.
Yeah, thanks for the introduction, Ida. Agenda, investment basics. Each portfolio is unique. There is not a silver bullet portfolio for everybody. It's all about asset allocation. And I think we do have some time for a very short platform walkthrough. And then, as Ida said, Q&A at the end. Now, what is investing all about? If I would give the definition, it is putting your money to work. But there are a few things to consider. And I didn't write it down. But if you want to achieve a high return, it means you're also willing to take a higher risk. But I think the shortest definition would be putting your money to work. And I think there are a few things to consider. Your goal, PPIG, and I will talk about it in a sec, your risk tolerance, investment horizon. And one of the books I co-authored, that was Investing is Not Scary. And if I would have to make a summary of the book, it would be, if you are investing, there are 3 pillars of success. The first one is you have to diversify. The second one, keep the cost low. And the third one, that is do it for the long term. And I always get a little bit of a stomach ache when people say, yeah, I would like to try investing for 1 year. I think it should be a lifelong commitment to do, to be in the financial market. But I will talk more about that. And long term is also a very good risk mitigating measure because the risk becomes less the longer the horizon is. PPIG is an acronym I more or less came up with, and it is for me covering, I think, 99.5% of the reason to be active in the financial markets. The first P stands for preservation of your capital. And sometimes I try to explain it to young people with maybe 500 euros in the bank account, maybe 5,000 euros in the bank account. But then I try them to imagine you'll be worth not 5,000 euros, but you're worth 5 million euros. So what is then the first thing you want to achieve? You want to make sure you're not going to lose that money. So preservation is the basics, more or less. Buffett said it once. He said there are two rules in investing. First one, don't lose money. Rule two, don't forget the first rule. So preservation, that is the key. The second one is income from your investments. That is not applicable for the younger people, but as soon as you get into the now call it early winter of your life, it is very nice when there is some income coming from your investments. For the young accounts, the third one, and that's the G of growth, right? The growth of your capital, because there is hardly or just a little bit of capital. You want it to grow, to live the life you want to live when you're older. So growth is also a very big reason. And when you connect that to the time horizon, you can say the younger you are, the more risk you're able to take, because you have still a very long time horizon. And you see it changing over the years. What is the main reason between the PIG? And the fourth one, that is the play part of being an investor. Internally, we say we want to get curious people investing in the world, and play is there a part of. I mean, play could also be if you buy something, if you buy a share and you can sell it 6 weeks later and you got a nice profit. That is play, but play can also be in trying to find what will be the coming decade, what will be the trend that really will be growing the fastest. Now, we've seen the last few decades that technology was a very big part of that. So I see the play part also as an intellectual play. When you are young, quite a few people start investing only because of the play part in combination with growth. And you must see growth there as become rich. And if you can do that in a playful way, then it would be perfect. There are some examples, of course, of people that were able to do so in the crypto space. But those, I would say, that those are the rare examples. But I do understand and I do get the appeal of growing your capital, becoming rich with playing in the markets, and maybe you're good at that and you're able to do so. But that's not the majority who is able to do so. And the last sentence is about that it will change over time. What is where you put your emphasis on? When you're young, it will be growth. And when you get older, it will be more about income and preservation. And I think play can be part of it all your life. And there are quite a few clients that I talk to, and they say, one of the reasons why I like investing, because it keeps me sharp. I read the newspapers, I dive into certain trends that are developing. And for me, that is really a reason to get out of bed and see what is happening in the world and where I can invest my money in. Here I visualize this. It starts with a toddler and you end here with an old man. And here is the money. And you could say that it builds up like this. And in the beginning, there's hardly any money, and you get older, there will be more money, income decreases, but there is still capital you earned earlier in your life. And what I also see with clients is that when they are getting older, they're also thinking about how can I give it to the younger generation. The other day I did a Dutch webinar about how to invest for your children or your grandchildren. And there was a lot of interest in that webinar. How can you do it? Because the more you go to the left, the longer the time horizon is for the people to be an investor, and how can I, as a parent or a grandparent, help my kids, my grandkids to become an investor. Also because there's quite a lot of experience when you are getting older, and it would be a waste not to pass it on to your children or grandchildren. If you look to investment products, it starts with on the lowest risk side. That is savings. Then you got money market funds. Then you got bonds. Then you got the stocks, and then you got the derivatives. And what is very important to be aware of is the fact that if you use baskets, they will reduce risk. Owning one single stock, we can see here it's already on the risk assessment. It's on the high risk side. But if you would own 25 stocks, the risk is becoming less. The same counts for bonds. So baskets of stocks and basket of bonds, they move to the left from a risk perspective. You could also more or less say the same about derivatives. Derivatives can be used very offensive, like call options. But derivatives can also be used in a more defensive way. An example could be buying a put option, and you can see that there's an insurance that you're always able to sell your stock for a certain price during the lifetime of the option. So they are placed, derivatives, really on the most risky side, because those are leveraged products, but you can also use them to reduce your risk. Bottom up or top down. When I talk to people, then when I say, how did you start investing? Most of them started off by just buying one single stock. They read about it, they heard about it, and they say, yeah, I want to be an investor, and I'm going to buy that stock. And they did have high hopes for that. When the stock is moving up and down and sideways, they learn that it is quite risky to be only invested in one stock. And as their experience grows, then they will put more emphasis on the asset allocation. I think asset allocation, that is the determining factor for both your return and your risk. And a way to reduce your risk is to diversify more. So in my ideal world, you don't start off with just buying one stock where you think that will go to the moon. You will start off building a portfolio with very well diversified building blocks. And I will talk about it. That can be the mutual funds, that can be the ETFs. And ETFs are a little bit in favor from my side because the costs they vary, they are much lower than mutual funds. And once you have the foundation there with those baskets, either mutual funds or ETFs, you can say, yeah, I'm getting more experienced, I'm getting used to the fluctuations of the value of my portfolio, but I also develop some views about some themes that I think are interesting, and I want to invest in those more. And then you're doing it just exactly the other way around. So you don't start off with the highest risk being one share, and you start off with the baskets, well diversified, the lowest risk in itself, and the more experience you get, the more risk you're gonna add by making more specific choices. How to start building a portfolio? I try to find a metaphor that would be very understandable. And I said, compared to building a house, where do you start when you want to build a house? Is it the color of the bathroom door, or is it the foundation? I think it should be, and it will be, the foundation. The bathroom door, that will come somewhere in the future. And I think the highest level to look to a portfolio, that is the asset allocation. How much in stocks, how much in bonds, and how much in other. Harry Markowitz, he got a Nobel Prize for saying that the right mix between stocks, bonds, and cash can lower the risk and keeping the return on the same level. That was in the early 50s last year. So it is a well-diversified portfolio is about asset allocation. And I will give an example later on. But for somebody, let's say it is your kid and your kid is only 3 years old. If you would have to build a portfolio for him, for me, it would be very well defendable to say that's 100% equity, uh, only shares in that portfolio. If you would start your investment career when you're 65, I think that other things are more important. That is the preservation and that is the income. You want to have lower risk. You don't want to lose your capital in the financial markets. So you will pick a lower risk profile. An example, and this is just an example, about allocation. Global stocks, meaning I want to own stocks from all over the world in all sectors, in all regions. And on top of that, I do have a feel about certain niches in the market, certain trends, upcoming trends that I want to invest in. And I picked here, and this is just an example. I want to have a focus on growth. That will be 10% of my stock ETF or of a specific stock ETF that focuses on growth. I want to have an emphasis on tech, technology, and I want to have an emphasis on cybersecurity. If you add it up, we come to 60% will be an equity portfolio, but there are already made some specific choices. The simplest equity portfolio would be 100% global stocks, and that's it. We also see in this portfolio 25% in global bonds, 10% in high yield bonds, and 5% in gold. And that all adds up to 100%. It would look like this. And this is just a way of showing how it could look like. I made this up. There are some tools available on the net where you can say what would be a portfolio for me, and then you have to give on some parameters, also your age, and I think that's good. And they will come up with an asset allocation on a high level, saying how much in stocks, how much in bonds, and how much in other things. And I think just about the asset allocation, that might be hard in the beginning, but it is the way to go. To make a distinction, no, try to figure out which asset allocation would suit you. Once you have your asset allocation, and it can be very simple, it can be a 60-40 portfolio, that would be 60 equity and 40 in bonds. You can use the strategy of dollar cost averaging. And dollar cost averaging is I think, the most realistic and easy to understand investment strategy. And there you say, I don't have the capital yet to allocate, let's say, 50K in the stock market. But I want to build up my wealth over time. And what I'm going to do, I'm going to put 500 euros, $500 each month in a well-diversified portfolio. And I think that is a realistic number. Maybe the 500 is too much for some of the young starters. Maybe they can do more than 500. But the trick is that you put a fixed amount on a monthly basis in the stock market. It's kind of the way you might be saving now in a savings account. Right? Your salary gets in, and automatically you book away, you transfer a certain amount to your savings account. You could do the same with your investment account. And in the other webinar, I also talked about, should I really stop saving then? No, because having some money in your savings account, It's good for your comfort and also good for the unexpected costs that you're able to pay for them when they come up. So dollar cost averaging is you buy on a monthly basis, and sometimes when the prices on the exchange are high and the valuations are high, and that is at this moment, you could say that might be the case, and all exchanges are reaching all-time highs. You put money in. If the stock market will drop next month, then you want to buy your second tranche for a lower price than you did today, because the price is lower, so you can buy more shares for the same amount. And that is the trick. You just keep on doing this month after month after month. I also spoke to a client and he said, yeah, I would like to start. I've been a saver for quite a while. He was around 40 years old. And he says, I've got 100K, which I would like to start investing with. And my advice was, if you put it all in at the same time, then you got a timing risk. And the timing risk, I mean, it can be the case that the stock market will go down in the coming quarter. So a way to approach that could be that you say, I know the amount which I want to invest, but I take 6 to 12 months to build up that portfolio. I'm not going to do it all at once. I want to minimize the risk of timing the market in the wrong time. He also understood that, yeah, if you would be waiting for the dip and then buy everything, yeah, when, first of all, do you get a signal that the bottom has been reached and you should buy everything now? No, you won't get it. But also, what happens if the market would keep on rising for the months and maybe years to follow? Then you are not in. So a way to avoid that is say, all right, I'm going to start and I'm going to take 6 to 12 months to get my 50 or 100K invested. And so you build it up gradually. Then I talked about the global stock market, all sectors. And here you see the 11 sectors that are taken into account when it comes to market sectors. And GICS stands for Global Industry Classification Standard. And it's energy, materials, industrials, utilities, and so on. So this is the highest level of different sectors that are available within the financial markets. What of course has been on the lowest row, that is the middle one, information technology, that has been the main driver at the last few years of the prices on the exchanges. If you go a little deep, one step deeper into the GICS classification, you see that the sector is materials, the industry group is also materials, the industries that fall under materials are chemicals, construction materials, containers and packaging, and metals and mining. And that is again divided in the sub-industry of commodities, chemicals, diversified fertilizer, and so on. The only reason to put it in is that you see that you can look at it on a higher level. You can drill down, and you can drill down to sub-industry level. And just to get a feel on what is happening, and let's look at the last column. That's the performance of the last 12 months of the 11 GICS sectors. And you see quite some changes. Consumer staples, the second one, for example, the performance of the last 12 months was a little bit over 6%. If you look to the bottom one, communication services, it was up 50%. And technology, just above that, is plus 53%. Now, it might be very tempting to say, yeah, I should have invested everything in technology, but then you are really increasing your risk. And the overall performance of the stock market over the last 12 months has been really, really okay. And with hindsight, picking the right sectors is always easy, but it's very hard to say what will be the winners for the coming 12 months. So for me, that is the reason to say diversify.
Peter, can you please just do something? Can you click on hide? Because that is at times hiding, covering the text. So don't click on stop sharing, but just next to it.
Oh, yeah.
Thank you.
All right. Yeah,
Thank
yeah.
you.
Sorry. Yeah, I put the source I put under it in the URL that's under it. All right. Yep. Oh. One of the building blocks I'm going to talk a little bit more on is the MSCI World Sector Weight. No, that is the MSCI World, and that's an ETF, and that can be seen as global equity exposure. If people say, I just want to have one basket that covers most of the stock performance worldwide, you probably will end up with an MSCI World. And it is good just to get a feel from how is that divided. And what you see, for example, here is that information technology, one of the best performers of the last 12 months. The weight of that sector is 24%. Financials is 15.3. Healthcare 12.06. So you see that there are different weights to different sectors. On the bottom, you see real estate is only accountable for a little bit above 2%. Same counts for utilities, materials, 4%, and energy also down. Nice to know. If you would go back to 25 years ago, the weight of energy would be somewhere between 15 and 20%. So it can change over time, and it will change over time how the weights are in the MSCI World. Another thing to have a look at, that is some of the different examples of ETFs with the MSCI World as a benchmark. I found a few within the universe of Saxo. There are more. And what you see is that they change a bit, but you could say if we could forget the top one, the MSCI World ESG UCITS ETF, but the other ones are between 26.7% and 25.1% performance over the last year. So that is also from an historical perspective, this is high. Normally, the world index does around somewhere between 7 and 9% on an annual basis, on average, when the dividends are reinvested. So the stock market really has had a run up over the last year. Then to the MSCI World, what we also see is that there is an overweight in the US. It's got more than 70% of the exposure is derived from investments in the US. Eurozone 9%, Japan 6%, Europe 4.75%, UK less than 4%. So it means that you are overweight in the US. And some people will say, I'm very happy with that, I'm totally fine. Others might say, no, I want to give more emphasis on Europe. So you can make a choice that you say, my global equity exposure, I will pick a US ETF, and the other one will be a Europe ETF. So you want to avoid the overweighing of the US in the MSCI World. Then the portfolio. I think KISS. I like KISS. Keep it simple, stupid, or keep it stupid, simple. I think you all know Warren Buffett. He's the Munger passed away just a few months ago, and he is running Berkshire Hathaway. He's considered to be one of the best investors ever. when we look to the performance of his fund over the last years, it is more or less mimicking the S&P 500. But in his early years, he was able to make really incredible returns year over year over year. And he came in the news with his advice to his wife, if he would pass away, how to invest his, then her money, after he had passed away. And this was the advice he gave. Buy 90% stocks, and he meant the S&P 500, so totally in America, and 10% US bonds. That is the asset allocation that Buffett gave to his wife after he would no longer be here among us. It can be very simple. It is very simple. And he kept it very simple. And maybe it's also nice to tell that in 2008, he invited or he challenged people, will you be able to beat me in the coming 10 years? If you do so, I give you $1 million. If you don't, I get $1 million from you, and we can spare it on a charity goal. Hardly anybody was willing to take that risk. At a certain point in time, he found one, and that was a hedge fund manager. And after 10 years, they analyzed the performance. Buffett won. And what did he do? He just bought the S&P 500. That's it. That was the only thing he did. And he didn't make any fancy things with structures, with very niche investments. He just bought the S&P 500. So from that light and from that angle, you can understand why he gives or gave this advice to his wife. Now building up a portfolio. I think global equities should be the basis. And this is the most simple equity portfolio you can imagine. It is just a global equity. And there are ETFs that do that. via, for example, the MSCI World. Is this a model portfolio for somebody who's 50 years or older? No, I don't think so. I think it's too much risk. Could it be a portfolio if you're 15 or 18 and then thinking about investing for your children or grandchildren? This could be very well the portfolio to start with. Although it is only shares, it is very well diversified within the asset class shares, because there will be 1,500 shares in this, and it will be in about 17 countries. If you make it a little bit more diversified, you can say the equity part is still the biggest one. And then you got a bond part, some real estate, because normally they are quite interesting because of the cash flow they generate. Quite a few real estate funds, they must give back to the shareholders 90% of the profit. So that can be a nice cash flow. At this moment, because of the rising interest rates, there is some pressure on global real estate. And the last one will be commodities. And this is just an example also of the weighing. You could say, I want to have a bigger part that's blue, some more equity. Bonds is okay. Real estate, I will skip that. And commodities, I will also skip. And then you got a equity bond portfolio. So this is the weighing of this is just hypothetical. If you would do this, and I think this is a very basic portfolio, you build it up, you set it up. You can say, I do my monthly investment divided in the right percentage. Oh my God.
It's all right. We cannot see your screen anymore.
No, I'm going to do it again. I will stop share and I will share again. Yeah. Share your screen. Here. And I think you can see it now.
Yes, we can see something. Yeah, but maybe you want to. Yeah, we can see it.
Yeah. All right. The basic building blocks. Once you've got it set, it is a kind of boring. And I mean, managing a portfolio like this, you can do that in 15 minutes per year. So it's very easy, but there is also no challenge from your side, and you don't have the possibility to intellectually play with being in the financial markets. So quite a few people say, I want to add to my portfolio, I want to add things that I believe in. And that can be, in this example, I take an ETF that follows the banking sector in Europe. Another possibility could be small caps in Asia, or an ETFs that follow the cybersecurity market. That is a more specific choice, and here your own views of the world are expressed. So you put on a personal touch layer. And if you would take that one step further, you would have single name stocks in it as well. Higher risk, but you see also that the capital allocation is lower. But there you can be the most specific about your choices. So it's building up building blocks, and on top you make more specific choices. You start off with sector or theme ETFs, and really on top you put single names in either stocks or bonds. When it comes to naming the strategy here described, you could say this is the core of the portfolio, the foundation of the portfolio, and you can call this the satellites. And the core satellite, you can Google on that one, you will find this as being the definition of a core satellite portfolio. And there is the core, and that can be 60%, can be 80%, and you got a satellite part on top of it. Another way of looking at this one is that active passive, and the bottom part you can manage passively. You will be a buy and holder on that part of the portfolio. You manage it passively, and you don't make any specific choices. And the upper part, you will be more active. And I like this approach because it also helps you in not spending any time on the passive part of your portfolio. You know you will be in that part of your portfolio for the coming 10, 15, 20 years. On the active part, you will treat it differently. And you can change your mind. What will be the trends for the coming year or coming 5 year, and that will be reflected in the active part of your portfolio. The bottom one, I see it as a must-do. When I walk around in Amsterdam and I look at the 1,000 people running around on the square, I think that all 1,000 of them must have the basic portfolio. They must have the core. And even if they would spend only 100 euros monthly, if they do it for 30, or no, if they would do it for 25 years, it will be worth around 80,000 euros with only 100 euros monthly. So that is for me, that is a can do. Also, in combination with savings, as said, it is good to have liquidity at hand. The upper part, that is a can do, and that is not a must do. You can do it if you like it, if you want to be able to reflect your views on the world in your portfolio. You can make more specific choices. All right. Then it comes to the time factor. Maybe a small anecdote. I I met a client, and he used to have an enterprise. He sold the enterprise, and he said, "Yeah, I want to spend some time on investing. I've got some time, I've got some money, and I really would like to do it." He was doing so, and he said at a certain point he was busy for 2 years. At a certain point, he realized that he was, even when he was having a lunch with his wife, he was he noticed he was still looking at his watch, or not his watch, at his phone, 3 times an hour to see how his investments did. And then his wife said something about it, and that made him think. And he said, "Yes, you're absolutely right. I really got sucked into it in investing, and now my screen is gone again." And then he said, "No, I have to pull back. I have to step back." Um, I don't think you can see my screen, huh?
No, but I can share my screen. I think maybe maybe that'll work. Just a second.
Yeah.
Here we go.
Yeah, I don't know where we are right now, but we are in the time
Time
span.
spent. Yes.
Yeah. Um, so bottom line of that story is you can also lose yourself in being an investor. It can take a lot of time, if you don't scope, if you don't limit yourself. So I think that is a relevant question. How much time do you want to spend on managing your portfolio? Um, and I know people that spend 6 to 8 hours a day. So it is a day job. It is a day job. They retired, but they found another job, and that's managing their portfolio. I think you really have to think about it. Do you want to have an easy portfolio with just some very generic exposure, or do you want to have a very detailed portfolio where the focus is not on the foundation, but much more on the satellites? I mean, you can really spend as much time as you want. And another thing is that normally when you give a topic more time, you will become better at it. In investing, that doesn't have to be the case. Um, I think that um, part of being a successful investor is not to do that much. But if it is your day job, it feels like you have to do more or less every day something. But it doesn't mean that you will get a high return at the end of the year if you would compare it to an investor that has his ETF portfolio, just the building blocks, and he checks it once a month and just have a look. All right, I'm fine, and go on. And if you would look at the performance at the end of the year, chances are big that the woman or man who spent just 5 minutes on a monthly basis watching his portfolio and not doing anything outperforms somebody who has spent 8 hours a week on managing his portfolio. Then the risk profile. I already mentioned it. The younger you are, the more risk you can take. And what you will see is that the risk taking will decrease. There are quite a few people, and when I talk to them, they say, if I look at the risk I was willing to take when I was young, I would never do that again. It served me because I made money on it, but the risk I took, I would never do it again. So you see that shift over time in the structure of the portfolio. And I think it really depends on your risk appetite, your investment horizon, your goals, and the time you want to spend on managing your portfolio. Those are a few of the parameters that will influence the outcome, but also the time you want to spend on it, and also depending where you are in your life. I wrap it up. Asset allocation, I think, is the foundation of the portfolio. I'm in favor of using building blocks to get 50, 60, 70, maybe 80% of your portfolio constructed with just a few building blocks. And then depending a little bit on your personal ambitions and available time, you probably will add the personal touch layer. And the personal touch layer is there you can express your views on what will be the trends for the coming time, for the coming decade. It might be that we say in the early 30s, so 7, 8 years from now, that biotech was the place to go. The combination biotech and AI can be very, very strong in finding new medicines. Can be the case. I'm not sure, but that's an intellectual question, and it is something you can chew on. Before getting to the questions that might be there, I would like to go to a quote from Benjamin Graham, and Benjamin Graham was one of the teachers of Warren Buffett, and he says, "The investor's chief problem, and maybe even his worst enemy, is likely to be himself." And what he expresses with that is, I think, he says, invest, do it wisely, but don't overdo it with doing too much transactions. You can't be fully in control all the time. And if you would look to a price graph of, can be Apple, can be Amazon, can be another company, there will be downturns. But at the end of the day, they are trading higher most of the time. I would like it here, Ida, if there are any questions, I'm happy to answer them.
Yes, they are definitely a number of questions. The first question is actually it's from Michael, and it's about the availability of ETFs like Vanguard, BlackRock, and Schwab on the platform. And I think I'll take that one quickly. Saxo is essentially a facilitator. So we literally have thousands of ETFs available on the platform. So if you go, and I'm going to share my screen here, another screen, and please let me know when you can see it. I'll go and mix. Can you see my screen? Can you see the platform, Peter?
Yes, okay.
Yes. So if you go here and, for example, click on ETFs, if you go to the bottom to explore all the ETFs, you have access to hundreds of ETFs. And here you can filter. I don't know what's going on, why I cannot go up. Let me try this. You can filter here. If you're searching for, you mentioned Vanguard, you go here and you will get a list of Vanguard ETFs, the same for BlackRock and the others. Now, I have to say that in some jurisdictions, some of those funds might not be registered. So that would be why you won't have access to those. But you should be able to find everything on our platform. And I'll move on to the next question for you, Peter. Dennis is asking about dollar cost averaging. Shall I add to a position only when price for an asset goes down, or whatever the current price is?
No. The trick about dollar cost averaging, and then I was not clear, it is a fixed amount of money monthly. So hey, you know you're going to buy every month, and you will do that for the coming years. So it's independent of the price. You just know you're going to buy for, let's say, 500 euros monthly. That's the thing. And if the prices are high, you can't buy that much for 500 euros. But if the prices are low, you buy a lot more for 500 euros or dollars. So on average, you pay a good price and a fair price. That's the key part of dollar cost averaging.
Okay, next question from Arne. Why should we still buy individual stocks compared to a bigger ETF? For example, the S&P 500, which spreads.
What should we steal?
Why should we still buy stocks and not just buy an ETF instead that is diversified?
No, I mean, it's a valid question, but then you say, I'm totally fine that investing is boring. And I think I can very happily live with that. That you say, no, my investment should be boring. I've got a life also, and I just buy ETFs and that's it. But you see that there are certain stocks that have certain appeal to people, and they gotta feel they're in the right sector, and they gotta feel that they will grow the coming time. So it's an expression of your view on that stock, and it is an expression, a more specific expression of your view on that particular sector. But if people say, no, I don't do anything anymore in individual stocks, I think it's very well defendable that you take that approach.
All right. We have a question here from Eddie. How would you use options to create leverage or to generate extra income? And I'll answer that question too.
But
This webinar. Yeah. Okay. Go ahead.
No,
I just wanted to say that we
yeah.
have 2 upcoming webinars dedicated to options trading, one for beginners and one for more advanced traders. But Peter, go ahead. You can add some flavor.
I think you ask two things: how you gonna add leverage, being more offensive, or how to create income, and that would be more in this style. And I think there are possibilities by selling covered calls, for example, to gain some extra income. And the more offensive way of using options by creating leverage, I don't think that would fit in this webinar. I can easily talk an hour about it, but not in this webinar.
All right. Question from Richard. More exposure to US markets means more exposure to US versus Euro. Is that correct?
Yes, that is correct. So there is also the currency risk is getting higher. And if you're based in Europe, you must be aware that it is a newly introduced risk, and that is the currency risk. You might be right in the direction of the US market, but if the dollar depreciates in value, you still didn't gain anything at the end. So it is something there. Personally, I would say when it comes to currency risk, if you are a long-time investor, it will average out over time. And it is one year it will be a tailwind, the next year it might be a headwind, but overall it will average out. But it is something to be aware of, that you do introduce if you start to buy into another currency risk is introduced. The good thing is that there are quite a few also global and also US ETFs that are dollar hedged or euro hedged. So meaning they have the currency is hedged away, so you don't have to bother about it. And it is probably, no, not probably, it is in the name of the ETF when they are euro hedged, for example.
All right. Patrick is asking, for those who want to earn an income from their investment, is it better to buy an ETF that is distributing or accumulating? And if you buy the accumulating one, just sell a piece at a time?
Yeah.
Considering taxation of dividends.
Yeah. I think there you can, when it comes to the taxation, it's depending a little bit on your jurisdiction. I would say accumulating when you're young, and then I would always pick as an ETF the accumulating, so the dividends are reinvested. And if you are older and it is more about income, I would pick the distributing one, because in that sense you also avoid the transaction cost when selling. I would make the change. It depends a little bit maybe on the taxes, and that differs from country to country. But I think as a rule of thumb, when you're young, accumulating; when you're getting older, you will be distributing.
Okay, Gunther is asking, does it make sense to manage actively, for example, once per month, your ETF portfolio core?
Yeah, that is a good question. There is a rule of thumb, and that rule of thumb says that your age is your percentage of bonds in your portfolio. And meaning, if you would be 25, there would be 25% allocation to bonds and 75% to equity. And when you're 50, it will be 50-50. And when you're 70, there is a 70% allocation to bonds. And I wouldn't do it monthly. Also, when you look to some analysis, should you do it on a monthly basis, quarterly basis, or yearly basis? A yearly basis is fine, but it is good to do it on a yearly basis. And what you can also think of, there might be certain brackets where you say that's where my asset allocation has to be in. And let's put it very simple. You got a 50-50 allocation. You could say if one allocation gets below 45 or above 55, right? The other one is getting above 55, then I will rebalance to 50-50 again.
All right. Mohammed wants to know your thoughts on maximizing current industry trends such as AI.
Yeah, that's a difficult one. I think it's a $1 million question. Where are we now? What you see is that valuations are stretched. There is quite some good news in the prices already. They must deliver on that. And you see, for example, that it's hard to do so for Adobe, and I think they are in the right place to use AI in a good way. Who does do is, for example, NVIDIA. It is, again, I think that is a question that I cannot answer right now. And afterwards, I will have an explanation. But it is very hard to say if we are at the top when it comes to AI. That is, I think it is, we can't do it. But that it has been a very, very strong performer, yeah, that is very obvious.
Okay, we're going to take two more questions, but in the meantime, I'm going to share my screen. If you could please scan the QR code for the survey, that'll be greatly appreciated. So I'm going to share it here and then leave it on the screen at the end of the hour. So we have a question from Alexandra, who's asking, investing small portions could be affected by higher fees. For example, my bank takes about $20 for Swift transfer to my Saxo account. What do you recommend in this case? Accumulate the money on the bank account during the year or?
Yeah. One of the things, and I don't think it's rolled out in all jurisdictions, is that we do see that the transaction cost also might be a hurdle. And the way we solved it in the Netherlands, at least, is that if you use Auto Invest, you're able to buy without transaction costs. The cost of transfer, that's another cost. And I think that it is wise to say, I want to minimize that, and I do it only once a year, and I know that I'm be able to do my monthly purchase for the coming year, and just put a reminder in the agenda that you do it again in a year. I mean, if that is possible, but you have to find a clever solution with this one, because it's a waste to spend $20 on a bank transfer. It's a shame.
Okay, it's 1 o'clock, but we'll take the last question. Alina is asking, for my 13-year-old son, I set up a university fund he can use in 6 years. Do you think I should do a portfolio of 55% S&P 500, 25% NASDAQ, 10% commodities, and 10% MSCI World? So 55% S&P, 25 NASDAQ, 10 commodities, and 10 MSCI World.
It is an offensive portfolio, and that asset allocation. If you compare it to if you really want to use it in 6 years to pay for a study, I think it's a little bit too offensive. If it would be his portfolio for the coming years, but it is more or less a target date portfolio, and I think there is some. It is a little bit too offensive.
All right. Thank you so much, everyone, for joining us today. Thank you, Peter. I'll put the
My
QR
pleasure.
code back on the screen. It was a pleasure to have you here, Peter, as always.
All right. Thank you, and thank you
Thank
for your
you.
attention. Bye
Take
bye.
care. Bye bye.